Okay, it's Dr. Gold again here to cover the final third video for chapter 3 dealing with cash flow. So let me just skip ahead to that section. Now, cash flow, as I mentioned in the first video, I believe is the most important financial statement out of the three because it really gives you a good sense of whether or not the company is managing its finances well or not, will be able to meet expenses, and it's incredibly important, especially for earlier stage business enterprises. Now, cash flow basically looks at how much cash did the company have on hand at the beginning of the period, what was their ending cash balance, and again, their beginning cash balance could be a negative or positive, and what was the change in that cash position over the period that you were analyzing. There's three basic sources of cash flow for a company. One is a cash flow from operating activities like their day-to-day operations of selling goods and services. Another is cash flow from investing activities, which might be purchasing new equipment like a tractor or computers or things like that. Did they invest money in something to make the company function better? And then the third would be cash flow from financing activities. And financing activities would include borrowing money from the bank or selling bonds. That would be a cash inflow because there'd be cash coming in. Yes, you would owe people money, but that would be a cash inflow for that particular period. And that increase in debt in that example would be reflected in the liabilities side of the balance sheet. Also, with shareholder equity, when a company sells stock and gets additional cash that way, that's a cash inflow. But then again, they've given up ownership or shares of stock to other people, and that gets reflected on the balance sheet as well under the shareholder equity section we reviewed earlier. When you add up these three things, cash flow from operating activities, investing activities, and financing activities, you come up with your ending cash balance, and typically it's compared with the beginning cash balance to see what the change in that cash position was. This is just a more detailed description of what those three categories are, which we've just recently talked about. So here's a cash flow statement, sticking with the same H.J. Boswell company. You can see it way up on the top here. The company started with $94.50 in cash at the beginning of this process. And then they had cash from operating activities, you can see here. They had an increase in accounts receivable. Now, accounts receivable is money that is owed to the company. So this company sold some stuff to somebody or a group of customers who have not yet paid for that stuff. So that's considered a cash outflow. That's why there's brackets around $22, 22.5, because that's considered a cash outflow. It wasn't money or cash rather that came in. It was money leaving in the form of a product or a service that has not yet been paid for. Increase in inventories. Well, again, in this particular case, the company has added to its inventory. So it's purchased more stuff that it's going to sell. But that, again, is a cash outflow because it had to spend cash to purchase the stuff to have as inventory. As a company reduces its inventory by selling the products that it has in inventory, that is a cash inflow. But here they built some inventory and added 148.5 in inventory. And then there's some other additional cash flows from operating activities. But in the end, the total cash flow, when you add up this section here from operating activities, is 173.25 or $173,250,000. Then investing activities. The company had also a cash outflow of $175 million. So the company clearly purchased some sort of equipment or property or something to the tune of 175.5. So that's a cash outflow. And then from financing activities, the company paid off some short-term notes. You can see here an increase of 9, which means that the company took $9 in cash and it paid off a short-term note. So that was a cash outflow. That's a good thing because on the balance sheet, under current liabilities, there would be a reduction in current liabilities by $9 million because the company had paid it off. But on a cash flow statement, it's reflected as a negative number because it was cash that left to pay back a short-term note or debt that the company owed. Then it says here that the company increased its long-term debt. So this is a cash inflow. The company borrowed money over a longer period of time where they won't have to pay it back for more than a year. And that money has been taken into the company. So that's a cash inflow. And then, of course, they pay dividends in this case to shareholders, and that's a cash outflow, which was distributed to shareholders. And you saw that on the balance sheet and income statement videos. So when you add up the total of $94.50 here, and you add up 173.25 and negative 175.5 and negative 2.25 from financing activities, you end up, you can see that the difference between the ending cash balance and the ending cash balance from the previous period is $4.50. Their cash balance has decreased by $4.50. So that's in essence what the cash flow or statement of cash flow is about. It's a very, very powerful document because it gives us an enormous amount of insight into, as I said earlier, how the company's managing its finances. We'll go into more depth on how to analyze the cash flow statement in other videos. But I do want to take you to Yahoo Finance and just kind of show you something that's readily available to you. This is Yahoo Finance, and the way you get to it is if you just go to yahoo.com, and this could help you with your stock market challenge competition as well. And then you click on finance. There's a whole bunch of videos here which we've covered related to news on finance and so forth. So if you pick a company, let's just pick Coca-Cola, and you scroll down to the bottom left, you'll see under financials that they have the financial statements for Coca-Cola here. So if you go to the income statement, it'll look like sort of what we went over with the income statement video earlier, where it shows you the company's revenues of 46, and again this is in thousands. You can see that here up here on the top right. So that means you have to add 3 zeros. So Coca-Cola sold 46 billion with a B dollars of soft drinks in 2013. They had a cost of goods sold of 18 billion and a gross profit of 28 billion dollars. And it flows all the way down to the company's net income here. And then you also have the balance sheet for Coca-Cola, which will show you the company's current assets here, cash and other items, receivables and so forth. And then their total longer-term non-current assets listed below. And then you have total assets here for Coca-Cola of $90 billion. Liabilities, you have current liabilities and long-term liabilities. And their total liabilities is 56 billion. So you can see that when you look at the current assets, Coca-Cola has $31 billion in total current assets, and they have $27 billion in total current liabilities. So they have more current assets than they do liabilities, which of course is a good thing, as we mentioned earlier. And then on the bottom is the shareholder equity piece. So again, if you were to take the assets of 90 billion and you were to add the total liabilities of 56 billion along with $33 billion, you'd get to the assets of 90 billion. Or if you took 90 billion in assets minus 56 billion in liabilities, you'd get to the shareholder equity answer as well. So I just wanted to tie that in. Of course, there's also the cash flow statement here as well, which we just covered in this video, which will have, for Coca-Cola in this case, cash flow from operating activities, cash flow from investing activities, and cash flow from financing activities. You can see, like in the example we did in the cash flow statement that we looked at for that Boswell company, Coca-Cola paid a dividend, almost $5 billion in dividend payments during this period. Coca-Cola must have repurchased shares of its own stock because this is a negative number. So it means that they didn't sell stock and get cash in. They must have taken cash that the company had to purchase shares of stock that were already out there. And we'll explain why companies do that in later videos. And then they had other financing or borrowing of cash inflows of $4.7 billion. So that's Coca-Cola's situation. They had a change of a positive almost $2 billion in cash over that period. But I just wanted to let you know that this information is available on Yahoo Finance for any company. So it's really an amazing thing, the amount of information that you can have at your fingertips relatively easily. So that concludes my videos for Chapter 3, which was just sort of a brief brushstroke over the financial statements, what they are, how they sort of work. Again, you must go over the end of Chapter 3, the practice activities and exercises, so you can do well on Exam 1. And that's basically it. We'll touch base with you either next week or the week after.